Hello, and welcome to the Logistics Management Podcast Series. My name's Jeff Berman. I'm Group News Editor for Logistics Management Magazine, as well as the Peerless Media Supply Chain Group. Today, it's a real pleasure to once again welcome back Tony Hatch to our podcast. Tony is a longtime friend of logistics management, and he serves as principal of ABH Consulting based in New York City. Tony has 3 decades of experience in the freight, railroad, and transportation sectors, primarily as an analyst. In his role at ABH Consulting, he's been focused on the freight transportation segment, particularly surface transportation, and is well known for his knowledge of the intermodal and rail carload sectors, where the various modes of freight transportation converge. Tony has spoken at several dozen specialized conferences. And prior to launching ABH Consulting, he was an analyst at Salomon Brothers, then also at Argus, Payne Weber, and NatWest Markets USA. And he started his own consultancy back in 1999. Tony also programs the Always Excellent Rail Trends Conference, which is held every November in New York City, featuring C-level speakers from Class 1 railroads, as well as the short lines and various industry experts, analysts, and association leaders. Tony graduated from Harvard and is also probably the biggest LA Dodgers fan you'll ever meet in your lifetime. And as we all know, they are defending champions, so life is good. Hey, Tony, welcome back.
Thank you. I think we've just taken up all the time with that introduction. So I want to say goodbye to everybody. Uh, Jeff, always good to hear your voice. Always happy to do this. Always good to talk to you, whether we're recording or not.
Yeah, feeling is mutual, and it's great to have you back on. So, Tony, why don't we just jump into sort of the nitty gritty? And by that, I mean, sort of, how do you think things stand? We're through the first quarter now. We're almost done with April. How do you sort of view where things stand from a rail carload and intermodal market perspective at this point of 2025? I guess I'm really referring to sort of volumes, service. Where are we standing here?
All right, that's a lot there. First of all, from the rail analyst perspective, we're not through the first quarter. When we're speaking here, we still have a couple of earnings reports,
Sure.
half of them to go, including the always delayed BNSF as part of Berkshire. Uh,
Yeah.
the biggest story is the political one, which is impacting the tariff, the trade war issues, the possible recessionary issues that are impacting capital decisions, et cetera, have definitely had an impact on near term, right away, right now, rail volumes and intermodal volumes. Some of it may be some form. It's a little bit controversial about how much pull forward do we have. Are businesses and ultimately consumers buying now ahead of things, or were they buying now before the first tariffs came in, knowing they were coming? Or are we really at a period where everybody's sort of just sitting on their hands because they don't know what to do? We're in some sort of combination of those two
Hmm.
conflicting thoughts. Volumes are, okay. Intermodal volumes were pretty good in the quarter, but were definitely worse in March than they were in the first 2 months, which indicates maybe there was some pull forward and that it's over. It's really hard to tell what the economy is certainly not booming, and that's across all three continents. Today, the day we're speaking, we have an election in Canada that'll complete the changeover in governments in all three USMCA countries.
Yeah.
Rail service is for the most part pretty good. One of the biggest story in the rail service sector is CSX, which is struggling to create a double stack capability through the Howard Street Tunnel in Baltimore. I visited that project. It's pretty extraordinary. And under COO Mike Corey, they made the decision to, instead of having a slow bleed and doing it over multiple years, to do it in 1 year and get it done before the Christmas rush for UPS, et cetera, in the fall winter. So they're doing this 1 year project, which means they've had a significant disruption in the middle of the network, and they've had the bad luck of having some of the wraparound, the alternative, routes actually suffer from storm damage in what's been a pretty bad first quarter weather story. I mean, we always have weather. We have good years and bad years, and this is not, a terrible year, but if on the scale of things, it is, been a tougher first quarter for weather, particularly in the east, than the last several. So
Okay.
while ordinarily they would just take, because they're running pretty well, all of them right now, that wouldn't be an issue. Since some of these are the detour routes, to be simplistic, that is added stress. So their metrics, as we call them, the dwell numbers and the velocity numbers, show really adverse numbers. I don't think that is showing up so much on the ultimate thing, which is trip plan compliance and other things. The customer isn't seeing it as much because they're working really hard to run longer routes and thereby have higher expense, but to get the goods to the customer. I think having been to a bunch of meetings in their region this fall with a lot of shippers, the customers are basically understanding of this and appreciative of the efforts. And unlike other great moves like the initial PSR implementation at CSX, there's a lot of dialogue, and that helps.
Okay,
That's the
terrific.
biggest service story. Everybody else is running pretty darn well. Could they get better? Absolutely. Must they get better? Absolutely. But we're in a pretty good service time now. Some people might argue, they're not being highly stressed. The volumes were up slightly in carloads in the United States by like, 0.5%. So that means that there's not, they're not being stressed by a lot of growth. The real test for the railroads will be when we do get a recovery, a full recovery, when we maybe resolve these political issues, if we do, how do they handle significant volume? Do the service levels get worse? Is the usual pattern? That's something that's a historic pattern the railroads are trying to break, but we haven't tested that yet.
Okay, great, great. It was interesting, Tony. I was looking back at some notes about regarding a conversation we had a little more than a year ago, and you said at the time that 2024 was sort of you're reviewing 2024 as a base year, which had not been the case prior since 2017. And the reasons you cited for 24 being that type of base year were things like the PSR conversion, cutting intermodal back at two major class ones, CSX and UP. You were looking back at trade war, I guess 1.0, and also looking back at the pandemic and the subsequent impact of labor shortages in terms of are there enough crews and things along those lines. How would you update your thesis, I guess, a year later? It doesn't have to be vis-a-vis each of those points that we talked about, but just I guess on a general level, what's different? What are some of the things you're looking at or maybe viewing differently or the same?
What I was really trying to outline there, and it had to do with the big white paper I wrote that came out the beginning of this year, and I was in the middle of working on intermodal, and I do
Yeah.
these every 10 years, and really looking at the 2002 and 2014 reports were very optimistic, and rightfully so given recent history, but 2014 saw the intermodal markets turn around 2018-19 when for the first time we saw economic growth not followed by intermodal growth. Intermodal had outperformed the economy, had
Mm-hmm.
outperformed everything else. And so why did that happen? And then I listed those reasons that you just listed, which combined with, you know, declining rail service, and part of which was the railroad's response to the pandemic, which was to use a heavy use of the furlough and whatnot. Railroads have proven to be pretty good at ratcheting costs down in a known downturn, and there was no more known, no bigger downturn than March 2020. What they were less good at historically is then getting back up to speed when things turn the other way. They handled the beginning of the pandemic recovery, the period when everybody was getting pelotons and whatnot, pretty well, but they
Yeah.
began to show real stress. And this is one of those times when, as volumes got bigger, railroad service got worse. Part of it is they were short of crews. They hadn't signed a labor contract. That was normal business. Normal timing of the labor contract turned out to be very poor for the railroads. And in fact, in the past, when 80% of rail workers would come back when you called back from a furlough, 30% were coming back. So you had rolling crew shortages in a network business, which is really a kind of a recipe for, if not disaster, then for real problems. And we basically began to get out from under that in 2024. And that's why 2024 was a pretty good service year. It actually served to act as a base year. And what analysts like for a base year, as they began to recover market share, domestic market share, which for intermodal, which peaked about a little under 8% in 2018, had gone down into 5.5% by
Mm-hmm.
2022, was back up to 6.1% by the end of last year. So things were trending in the right direction. And it was a good year to say, okay, if this is a normal year, how do this is the year we can use as a measurement. And now, how much better will your service get? How much better will your market share get? Unfortunately, while that was setting up as a base year and those things were happening, we then hit this year. And
Yeah.
I hated being correct, but I was really shocked by how positive some of the railroads were about the electoral results. And I'm throwing out the political, voter side. I'm like being a rail analyst. They really expected great things out of this. One thing they expected that was obvious that they will get, which is a much improved Federal Railroad Administration, which will ultimately, I believe, allow a lot more technology to be employed in the rail space that have been held off for 4 years. But almost by every other measure, they're facing problems. And the biggest is that I believe the AAR greatly underestimates the trade impact on rail volumes. And this is intermodal and carload. Intermodal is
Hmm.
obvious, right? Because they say it's about 38% of rail revenues. And I would argue that the AAR excludes the Canadians and the Mexicans, and rail analysts and rail shippers don't exclude CPKC, which put a
Right.
$30 billion bet on this. It excludes inputs into things that are traded, such as fertilizers that go into the corn that goes down to Mexico, the largest U.S. grain export market, corn to Mexico. John Deere tractors and all that. It excludes transloaded containers in L.A. Long Beach, which is enormous. As half the business goes from 340-footers into 253s, and it excludes everybody's growth plans. In other words, it's a backward look. In a forward look, we expect a much higher percentage. So this year, the idea of having 24 be a base year, and then we would look to 25 to see what improvements, if any, and I expected improvements could be, has been kind of shattered by this. The one other point I want to make about the 38%, I think it's closer to 50, is that rails are, for the most part, a derived demand business, by which I mean they need to see what their shippers are going to do. What is Ford going to do if China, where are the tariffs going to settle out? What's Amazon, Archer Daniels Midland, Dow Chemical, Ford Motor? All the railroads could do right now is sort of wait on decisions made by other people in a time when there is no stability. So how do you make a decision? Whenever people listen to this, maybe we'll have more actual codified rules, and we'll know. But at this point, we're sort of in this, illusionary world of like where we don't know what the future is going to hold in any way. And to make
Hmm.
a decision to change your supply chain requires a lot of money, a lot of time, a lot more time than I think a lot of people are giving credit for. And it takes a measure of confidence in certain things, the rule of law, the rule of contract, the regulatory environment, et cetera. This switching back and forth all the time is the absolute enemy of any kind of long-term decision making. And just as rails are trying to move into a longer term decision making, the world is making it harder to do that. And what I worry about from a rail perspective is the one thing we know they can do is cut costs. And if you continue, they haven't grown for 5 years. And if you continue to put in a world in which growth is hard because their customers aren't growing and their customers don't know what they're doing, you may force those short-term shareholders back out into the open for the railroads, the ones who attacked Norfolk Southern last year, for example, in that proxy fight. That
Yes.
would be no good for anybody. It's sort of a race, but the rails want to change from a focus on short-term margin to long-term growth. And unfortunately, they've made the decision to do this, a correct decision, one that is very pro shipper in intermodal and carload. But they've made these decisions right at a time when there hasn't been growth, and where growth now looks less assured than ever, over the intermediate term, because we may hit a recession. We don't know what customers are going to do, et cetera, et cetera. It's very unlucky timing for railroads, but it is, so that's what I'm watching. This is not going to be a base year, Jeff. This is going to be, a crazy year. It already has been. I don't know if it can get
Yeah.
crazier, but it's been a crazy year from a rail perspective because it's been a crazy year for a rail shipper perspective.
Yeah, I mean the level of supply chain uncertainty, to say the least, is incredibly high, and something that we've obviously been writing a lot about here at
Of course.
Logistics Management too. I mean, it impacts everything, and I
I think
guess
it's been the highest ever. I mean, I can't imagine time. I mean, I guess the very beginning of the pandemic when we didn't know what we were facing. I mean, that was scarier because we didn't know.
yeah,
Here we have looked at the enemy, and the enemy is us, to quote Pogo. So
yeah, yeah. I mean, and that's interesting, Tony. That's a pretty fair point there. I mean, when you look at the uncertainty and we talk about tariffs and how intermodal, obviously, for example, is so consumer driven, is there, I mean, and we saw some data, some comments out of the Port of Los Angeles in the last couple of weeks looking at what they're expecting for inbound volume declines. And intermodal, obviously, it would be a big part of that bucket. How much of a concern about consumer retreat on intermodal volumes is there, in your opinion? Is it overstated? Is it within
No,
line? I mean, how do you view
well,
it?
I would view the intermodal business, which has really got to be the growth lever for railroads. Part of the fight in the rail investor community is the importance of intermodal. um, because it's lower margin, but we need the growth, and
Yeah,
it could be good return business. And I would say concern about the consumer is, over the near term and intermediate term is extremely high because of, all the things we're talking about because of the rising cost of goods means that you buy less of them. But another piece of the intermodal supply chain to worry about is for some reason the auto industry seems to be right in the sights of the
yeah,
administration,
yeah,
between higher tariffs on steel and aluminum. I mean, the idea of helping the steel industry, but hurting all the users of steel, which are much larger industries, construction, pipes for energy, and automotive, right? So the auto parts business is a big part of those boxes, and that's an issue. And so you have a lot of concern. And mentioned the Port of LA. The Port of Long Beach came out and said they could expect as much as a drop of a fifth, 20% level
yeah,
drop.
yeah.
Um, and so, we're not seeing it yet, right? But all the tea leaves seem to be, all the tea leaves seem to be burned, you know.
No,
Uh,
for sure. Yeah,
it's but the fact is that we retreat from some of these things. This art of the deal is very weird. We make a bold statement and then back away from it. It's, in many ways that's going to be a lasting issue because businesses and supply chains will adapt to the changes. But the fact that you're just ripping all this up and not replacing with anything permanent, you used the word uncertainty. I was searching for it. The clarity is another word, right? There just is no
yep,
clarity. The crystal balls are not just cloudy; they've been thrown against the wall and shattered. And with that, you need certainty. If you said this is the regulatory regime, maybe it's a stupid decision, but here it is. I'll adjust to that. I'll move plants here. I'll do that. But if you keep moving things around,
yeah.
even if that may be looking at it as a temporary victory, well, we didn't do, this enormous mistake here, but it still means that the boardrooms of the customers are just throwing their hands up in the air, and the railroad's waiting for that customer to make a decision, or just sitting by staring at the phone.
Absolutely. I mean, it's worth noting that very pro-business organizations such as the United States Chamber of Commerce, the National Association of Manufacturers, they're all echoing the same things that we're talking about right here and now. And it goes back to that lack of clarity, i.e., uncertainty, whatever you want to call it.
Absolutely. And I really want to say that I'm using my railroad, hat here. From their perspective, several of them, you have railroads with more or less exposure. Obviously, nobody's more exposed to USMCA revision, which is due next year and could happen if he turns his attention back to it. That's CPKC, right? But even
Yeah,
the eastern railroads in the U.S., which have the least direct exposure, still are heavily exposed, and they're massively equally exposed to any kind of slowdown in the economy, which this could cause by raising the price of goods, raising inflation. I'm not going to predict that. I'm not an economist, but we weren't thinking those things 6 months ago. So economic
God,
slowdown.
no, yeah, yeah.
So
No,
I agree with those business leaders, and I know we're saying some things that other people have heard, but keep in mind it's one step more difficult again for railroads. They can't make a decision. They need to have somebody else make a decision, and then they react to it. That is, if Ford, opens new plants, I'm just making this up because opening new plants, by the way, take anywhere from 1 to 10 years. I mean, these
yeah,
are long-term decisions, but if they move somewhere, if they change their supply chain, then the rail industry reacts to that. Until they
absolutely.
do, they don't know, they have nothing to go on. So they're even in a state of more uncertainty. It is the problem of being in a derived demand business. There are areas where they can go and actually seize the future for themselves. And that's why I've always been excited for domestic intermodal, which started to regain the lost market share in the last year and a half. Actually lost a tenth of a point in the last quarter. And why is that? Well, because the trucking industry, the trucking recession, the freight recession has been actually prolonged by this.
Yeah.
So what you're seeing here is, too much truck capacity, and if the economy slows, that'll be a self-fulfilling prophecy. So the rails are going to survive all this. I want to point out these are really uncertain, to use your term, at times. The railroads still carry a lot of critical goods. They will survive. There are other industries and other companies that may not, but they will. But the question in the near term is, what do they do? And they're kind of being buffeted by all sides.
No, that 100%. Couple more quick ones here, Tony. I guess separate from tariffs and trade issues, how do you how are you viewing what's going on with pricing and rates at the moment within carload and intermodal?
Well,
Is that getting a lot of attention on the earnings calls this time around?
it
What's
is because everybody has slowly gotten to the assumption in the investment community. It took them a while that railroads don't have really much to say about tariffs, because of the derived demand issue that I just talked about. I mean,
Yeah.
I would say the Western railroads have been more honest about it than the Eastern ones to some degree, but they all talk about price. They always do, and price has actually remained, with improved service. And especially improved service at the ones that were struggling a little longer than others. Specifically talking about Norfolk Southern, the East, and I think we'll hear that from BNSF in the West as they, are sort of recovering their service levels back to group levels, and their margins back to group level, like levels. I think we're seeing decent pricing, and in fact, Union Pacific just said the other day that it was one of their best pricing quarters ever. They were really referring to carload in
Hmm.
this case, but I think pricing has held up, and part of the reason is, ultimately, if you're in the carload thing, if you can give share to the railroads and give share back that you might have pulled away during the time when they were labor short in 21, 22, you actually will save money. You can take a case can be made. I don't think we're going to see enough to make rail numbers jump, but that you can increase your rail business at higher rates, but save on your logistics bill because railroads are more efficient. So, I would say, uh, rail pricing is going to be a bright spot in a
Hmm.
very, in the fog. That might be the one, light you see at lighthouse you see is rail pricing. I mean, the other
Yeah.
should be, rail service. I expect to continue to be pretty good, and I would think that the job issues are going to be easier, and they've already got 50% roughly of the labor contract for the labor contract due in 3 years already signed. So we have labor peace on Canada, where there were a lot of strikes last year. We've had arbitration. On the U.S., we're pre-signing a lot. So that's a bright spot. Some of the problems we had in the last several years have been addressed. Service, labor contracts. That's also true in the port side, as you know. So we have labor peace, we have good service, we have adequate number of employees wanting this job. You have crew shortage issues having to do with work rules that need to be worked out. You should get better technology employed, things like automatic inspection of both track and cars, which will lead to fewer, better service, more
Yeah.
efficiency, et cetera. Those are bright spots, whether they will look like as you stare out, in Portland out to the sea, you'll see lights of some ships, then you say, oh, that ship's doing okay. But you're mostly going to see fog. But within the fog, I just mentioned a couple of bright spots, and those are good for the long term. This too shall pass, but it's really good that people like Joe Hendricks and CSX and others have made a case for changing the culture of confrontation on the labor side, creating fostering a better culture there that's going to have long-term positive impacts across the industry.
No, I absolutely. And just to wrap up here, Tony, from the perspective of a rail shipper, intermodal shippers, what are sort of the things that they really need to be focusing on and paying the closest attention to throughout the balance of 2025?
Gosh, that's a hard question, Jeff. The probably I would say that for them, since there are going to be no big disruptions in the roads, they don't have to worry about a labor disruption, or having they in many ways, the one thing they can count on is they don't really need to worry about the railroads at all.
Hmm.
They need to worry about the other side of their ledger, like where are the boxes going to come from, where are they selling goods, et cetera. I think that the supply chain as it is right now is going to work very well for them, and that really includes in a large part the railroads. I think railroad service will be fine. There'll be some issues at CSX if they get weather, but basically, I think they're working that out. So I don't think they need to worry about railroads. They need to worry about demand, and both they and railroads are going to worry about the demand.
Yeah. Yeah.
But I because of the labor situation, because of a pretty good capital spending on the railroads, and because safety's gotten better, railroads, they're always going to be there's going to be agita about price because that's a frictious relationship. But I think railroads are going to be a bright spot for shippers. They may not remember it that way because everything else is so dark.
Yeah, no, understood. All right, listen, Tony, this brings us to the end of our allotted time for today's podcast recording. So, on behalf of Logistics Management Magazine and the Peerless Media Supply Chain Group, thanks again for spending some time with us.
Jeff, I love to do it, and I'm really apologize for as we're doing this being in a time where I have so little clarity, and we could I could be wrong, but usually I try to give you here's an answer. I think this is going to happen, or that's going to happen, and I apologize for not being in
Oh,
that position right now. I think it would be disingenuous to be. Maybe we could talk again in a couple of months when things have been
sure.
resolved.
Yeah, I mean, it's just the times we're living in at
It
this
is.
moment, and hopefully we get more clarity as the days go on.
It
Um,
is baseball season though,
Yeah,
so I've got that.
yes, that is true. That is true. So for those of you in the audience, please feel free to go ahead and give us a follow on Twitter. That's simply at logisticsmgmt. And if you're not signed up for our podcast, please go right ahead and do so. Just look for Supply Chain 24/7 wherever you get your podcast. Thanks, everybody. Have a great day, and we'll catch up with you soon.
Thanks.
Thanks, Tony.